In today's video, we are going to discuss two different dividend options that you can select for your whole life insurance policy that's set up for maximum cash value. So when it comes to dividends, this is something everyone is attracted to. We've got a dividend paying whole life insurance policy, and we can elect for dividends to be allocated toward our cash value, meaning reinvested into the cash value, which can result in more money for you. So when it comes to different dividend options, there are a lot of them, and different companies have different dividend options that are available. Some companies have the option to elect for dividends to purchase you long-term care additions if you've got a long-term care rider attached. We're going to focus on the two most efficient options when the goal is strictly cash value. If you're saying, how do I maximize the cash value? What is the best option to maximize my cash value? Like, what do I select here? So I'm going to go through the two best options, and then I will give you my opinion, meaning which one I prefer, and let's get on into it. So dividend options, we've got two here. I've got 3 bullet points, but the first option is paid up additions. So you'll see this referred to as PUAs, which is very similar to your PUA rider, where you can add money into PUA payments, which accelerate the cash value growth, also purchases you more death benefit. But you can elect for the dividend option to be PUAs. And then the second option, we've got OYT, then PUAs. OYT stands for 1 year term. So it's a term insurance rider that's attached to the policy. And how this rider works is that any dividends that are paid to your policy first satisfy the term cost, and then everything else is kicked into PUAs. PUAs, here's the sweet spot right here, or why everyone's attracted to them, is because they build cash value. So let's take a look at these two options. We're going to first look at a whiteboard demonstration, and then we will look at some literature on life insurance illustrations. So when it comes to a policy, what we've got to the far right, dividend options. Option A, PUAs. Option B, 1 year term rider, and then PUAs. Which one's better? Beginning with the fundamentals of policy design. So let's assume you are going to add $10,000 into your policy, and you can decide if you want to pay that toward the base premium or the PUA rider, or you just want to understand how these two areas work. And this assumes money that is out of pocket. You are actually paying it into the policy, whereas a dividend is something you're receiving from the insurance company. So starting with this is the 10 grand you pay into the policy. If you pay 10,000 toward the base premium, what will you see in the first year of a policy? If it's a traditional whole life insurance product, typically nothing in cash value. Now, this will depend on your age. That might purchase you, let's call it $500,000 in an actual death benefit. So the base premium is buying you a death benefit, the actual life insurance policy. Now, as you continue to make those premium payments, what you will see is on a guaranteed basis, money will come back to cash value. In addition to that, dividends may be paid to your policy as well, which will accelerate the cash value growth. That'll also push the death benefit up. That's purely on the base premium. Versus PUAs, if you were to pay the same $10,000 into that PUA rider, what you would see is that money would show up in cash value immediately. Depending on the company and their PUA rider fee, that may range somewhere between 90 and 95% in the first year. Then it begins compounding. You see a positive return, meaning more money in cash value than what you've paid in, and it gets better and better. We talk about this all the time. This PUA rider with money you're depositing into the policy is the key to accelerating the cash value growth on a product, a whole life insurance product. Now, with respect to the death benefit, if you pay $10,000 using that number into your policy, we see the cash value benefit. That's great. It will purchase you additional life insurance as well. And that may be, this depends on your age and product, that might be $30,000. And the term PUA, again, stands for paid up additional life insurance, meaning how the insurance company views this transaction is when you make the $10,000 payment, yes, we're doing it for the cash value, but that buys you another $30,000 in life insurance. And why it is paid up is because the PUA payment is optional, whereas the base premium will be billed as long as that policy is as long as premiums are contractually due in that product, unless we look at a premium offset or a reduced paid up to get rid of it. But this is billed, where this is optional over here. Yes, we can set it up or we pay it the same time as the base premium and we're treating it as a bill, but we could reduce that PUA payment if we wanted to. So we've got flexibility there. So how this ties to the dividend, because this is all going to tie together, I promise. Let's take a look at dividends. So if you have dividends that are being paid to your policy, we could pretend that the dividend is $1,000, but for the sake of consistency here, let's pretend that you receive a dividend of $10,000. And you know what? Because we've got blue above, let's put this in purple. And to follow, assume that purple reflects money that you are receiving from the insurance company. So these are dividends that they're paying you. You see it on your annual statement, and your cash value increases as a result. So the dividend, if you selected option A, this is what we're looking at here, option A, PUAs, what would happen is that this $10,000 payment, that's the dividend, goes into cash value. You see it show up in cash value just like you would see a PUA payment if you actually paid 10 grand in. So there we go. And it also purchases you additional death benefit of guess how much? About $30,000. So what you'll see is if you have the dividend option elected as PUAs, that's going to function very similar to PUA payments you actually make toward the policy. That makes sense? So the standard dividend option that most people have on whole life insurance products is paid up additions, which just results in dividends being reinvested into PUAs, shows up in cash value, and also purchases you additional death benefit. Let's take a look here before we transition to the next option. So here we've got an illustration. The dividend option selected is paid up additions, and here we go. Dividends are used to purchase additional paid up insurance, PUAs. PUAs purchased with dividends will increase the cash value and the death benefit. Let's look at the actual numbers. So this is an illustration where we've got 100 grand per year going into the policy, but we do not have a term rider attached. So we've got a very high base premium, higher than I prefer. It's at $40,000. And why it's so high for this 40-year-old individual is because of the MEC limit. That 40K base premium with this design, this 40-60 split, gave him a MEC limit of a little over $100,000. So here's our net payment, 100K per year for 7 years. We can go longer here. We just did a 7-pay. There's your base premium, 40K. How much of that shows up in cash value in the first year? Just about zero. It's a little bit more than zero. You can actually see it right here. This column, base guaranteed cash value, reflects the cash value buildup of the base premium payment only, so the $40,000, and it assumes only the guaranteed rate is applied to that base guaranteed cash value column forever. I don't like it because it kind of displays an unrealistic scenario. The moment we add PUAs and receive dividends, that's why we have the other columns here, and it becomes somewhat invalid. But it does help with seeing exactly how much of my base premium payment I get in cash value in the first year. Next to nothing. We pay $40,000 and we've got $1,400 in this product. So here we see next to nothing show up in cash value from the base premium payment. However, your total payment was $100,000. The other $60,000 was a paid up additions rider payment, PUAs. Okay, great. So first year, no dividends are paid, it's a zero. So our cash value is reflective of what? The PUA deposit I make plus the small cash value buildup from the base premium payment. So net cash value is your money column. Now there is a PUA fee, which is why I don't see the full $60,000 show up right away, but I get the majority of it in the first year. But here's what I want to hit on that's very important here. This column, cash value of all adds, represents money you add to PUA payment. So this again is money you're paying out of pocket. You paid this $60,000 in. What happened? 55K, 55 and change is how much actually showed up in cash value. And then also what happened here is it purchased you additional death benefit. Now, where you can see it, how we can kind of piece everything together on this particular illustration is as follows. Day zero, before you add anything into the policy, you've got this death benefit over here, $2,050,000 in change. That is purchased from the $40,000 base premium. What's your net death benefit over here in the far right? Let's circle this in blue. At the end of the first year, it's $222,000, not the $2,050,000. If we did not have PUAs and we just paid the $40K base premium, the first year, that net death benefit would match this figure over here. Why it does not is because we added funds into PUAs. That $55,000 bought us, let's call it another, what is that? About $170,000 that is added to this. That's where it comes up with the $220 and change. So PUA payments do buy you more whole life death benefit. Now, back to the dividend option. You'll see exactly how this is going to tie together. We keep adding $40,000 per year, but now there's dividends that are coming back. The dividend option, PUAs. So what happens? We'll see this accelerate the cash value growth. And in addition to this, it'll buy us more death benefit. Year 3, I see the dividend payout, $10,860. The dividend option, again, it is here in all years, paid up additions. So what's happening is these dividends are getting kicked back into cash value, and they're purchasing me paid up additional life insurance as well. So I'm just having everything go back into cash value, continues to grow tax deferred, and I can access tax free if I do not trigger a taxable event. So that's option A, dividend option, PUAs. Option B, let's take a look at this. So let's assume that I have a policy with a term rider attached, be a OYT, 1-year term insurance rider, but the cost of that is $1,000. So what will happen in this case will be very similar, is if the cost, it'll be less than this, but let's just assume it's $1,000, is $1,000, and the dividend you received is the same $10,000, what will happen here is that dividend payment of 10 grand will first satisfy the term cost, and then after it's satisfied, the other $9,000 will be kicked into PUAs. So a small percentage of it will go toward the term rider, and this especially is true if you're not paying anything into the policy. If you're paying the policy, a lot of times what will happen is you'll cover that term rider cost, and it is very minimal. But this option, on the surface, it looks like it's not quite as efficient as option A, the PUA rider. And the reason why is because if all things are equal with the dividend payout, what will happen? Well, some of it has to satisfy the term cost first, which naturally leaves less for the PUA payment, and therefore I might think that I will end up with less in cash value. However, it's actually the opposite if you set things up properly. And here's why, is that example we just looked at, 100K going in, what was the base premium? $40,000. So adding this term insurance rider, a 1-year term rider, what it does is add more life insurance to the policy. It increases it. And the importance to that, if one says, hey, I'm interested in the cash value, Steve, the importance to that is that raises the MEC limit. So by adding more death benefit through term insurance at a low cost, what that allows me to do now, if we go back to that illustration, do you remember what the base premium was? It was $40,000. That's a heavy commitment for someone who wants to pay in 100 grand per year. So now what we can do, instead of having a $40,000 base premium, so it was 40. Let's get rid of this. And instead, we can make it $10,000. When it was 40, how much of the 40K went toward cash value in the first year? Next to nothing. If it's 10, guess how much goes toward cash value in the first year? Next to nothing. But now what you can do, so assuming that your payment is the same, we're going to look at an illustration in a second, same 100K going into the policy, what we're able to do is instead of having $40,000 toward base premium and $60,000 toward PUAs, now what we can do, bring the base premium down to $10,000, PUAs up to $90,000, and we see more cash value in the policy right out of the gates. So what that does is allow more of our dollars to be able to go toward PUAs, regardless of what the dollar amount is. Does not have to be $100,000, but you will see more cash value in the product as a result. And then also, when dividends are paid, dividends go where? Well, first they satisfy the term cost, which will be minimal, and then everything else is kicked back into PUAs, which will accelerate your cash value growth. Let's look at the actual numbers though, shall we? Because this can be difficult to follow. So if we look at this guy, here we've got our dividend option, level Q term, purchase OYT, and additions to equal target Q. Right? It looks like code or something like that. So 1-year term insurance rider with target face amount. Dividends are used to purchase 1-year term insurance first and additional paid up insurance to attempt to achieve a target additional benefit. I'm going to show you exactly what that means in a second. Particularly this is what I mean when I say that target additional benefit. The current 1-year term insurance rates are not guaranteed, meaning they can raise the term rider costs if they want to. I would check out any of our 1-year term transparency videos as we go through those guaranteed costs. And then 1-year term costs are payable as long as there is term coverage in effect, meaning the term rider is still attached. What you will see, it eventually burns out, and also we have the option to reduce it or remove it altogether. So let's take a look here at the same illustration page that we looked at before. So what we've got here is as follows. There we go. Last example. What was that premium toward the top right? It's 40 grand. Is it $40,000 here? It is not. It is $9,000 and change, which buys you a whole life death benefit not of $2,050,000 if we go back, but of $462,000. And this is important here with that MEC limit. That may only get you a MEC limit in this particular case of right around 20K. We're paying in 100. We need to prevent the MEC to prevent the taxable event. So to do that, here we go. Target additional benefit, 1.8, almost 1.9 million. What this is this 1-year term. And look at this amount, 1.630. Whereas up here, it's almost 1.9. Why the difference? I'll show you in a second. Here's the actual cost of the term in the first year. So up here, base premium. Then we've got here a scheduled PUA payment of $2,900. Check this out. PUA rider premium includes $652, meaning the scheduled PUA payment I have is first satisfying the term cost, and then everything else is being kicked back into PUAs. So if you're not satisfying that term cost out of pocket, then dividends will be used to satisfy the term cost. If dividends are not being paid to the policy, if it's just the guaranteed rate, the same will apply. The guaranteed rate will satisfy that term cost if you're not paying it out of pocket. Okay, so that's covering it right here. And then we've got PUAs unscheduled because the individual wanted to pay 100 grand per year in. Now, let's go back to that other point we mentioned here. Why is the target additional benefit up here 1.8 and down here it's 1.63? The reason why, this is day 0 before you pay anything into the policy. Once you make a payment to a life insurance policy, particularly a PUA payment, what happens? Grows your cash value, also grows your death benefit. So if we isolate the PUA payments here, first let me hit on this base premium, first year, that's what shows up in cash value, small percentage. Let's look at the PUA. Here's your PUA payments minus the term rider cost. This column, cash value of all ads, represents PUA payments you make minus the PUA fee, but then any and all dividends and interest applied to the policy, the guaranteed rate and dividends. So This represents the cash value of PUA payments. I like to think of it of cash value of all adds, money I add to cash value. The column immediately to the right of this, circle this in green, total face amount of adds. This represents how much additional whole life death benefit is purchased from your PUA payment. $256 and change. If you take this number back to the 1-year term amount, let's start with this number, the 1-year term on day 0, subtract it by the $256 and change, guess what you get? This, which you'll also see here, the next column to the right, face amount of 1-year term. So what happens if we go back to the illustration with just the $40K per year, no term rider? When you added PUAs, what happened to your death benefit? It increased. Day 0, it was 2.05. After you make the 100K payment, it's 2.2. This example, we added a lot more in PUAs, but what happened is your whole life death benefit still went up. Just because you've got this term rider attached, first, the term is bought down. So by the amount the whole life goes up, the term comes down, keeping you level at what the company refers to as the target amount, target additional benefit. See how that lines up with the terminology? So very fun stuff and easy to follow, right? A lot of fun with this. Purpose to this, going back to the dividends, because this is the main purpose. Here we've got a dividend of $5,000 and change. You see this dividend. Let's assume you're not making any payments. What'll happen is first, the dividend will satisfy the term cost, and then the rest is kicked back into PUAs and accelerates the cash value growth. So that is definitely a deep dive really on how that 1-year term rider works along with the dividend option. But between the options that are available, dividends, when you actually receive dividends from the insurance company, if it's PUAs, goes into PUAs into cash value. If it's 1-year term and then PUAs, first it satisfies the term cost unless you are funding it out of pocket, then that's set up where that's covered by your out-of-pocket cost, and then the dividends go into PUAs. But I did want to mention which option I prefer and which one I think is best. And the 1-year term rider, there's 2 reasons behind it. So I would pick option B if it was my policy. And the reason why is A, I'm able to reduce that base premium, which allows me to get more money into PUAs, which translates to more money in cash value, both on a guaranteed and non-guaranteed basis. But then number 2 is flexibility. So if we look at the 2 illustrations, and we'll close with this, if we go back to option A, we've got that $40,000 base premium. Aside from the MEC limit, the insurance company, this is Guardian, and all companies have different rules here, but aside from the MEC limit, there are going to be PUA limits, meaning there's a comfort level as far as how much money you can add to PUAs above and beyond that base premium. And specific to Guardian, what it is, in a design like this with a basic paid up additions rider elected, is the first 10 years, it's 3x the base premium. From the 11th year onward, it's 1 times the base premium. So what that means is if this is your policy, maybe we attach a renewable term rider, not a 1-year term rider, you keep the same dividend option, but we attach a renewable term rider in order to raise the MEC limit, but your limit's still 3x because it would be. What that means is you could add a maximum of another $120,000 into PUAs per year. Whereas if you had a 1-year term insurance rider attached, then what happens is the insurance company looks at this is specific to Guardian, they look at whatever your base premium is, and we can illustrate 10x the base premium in PUAs. The reason why, I almost neglected that, is when you add funds into PUAs, that buys you more death benefit, which the insurance company does view as a liability. So when a 1-year term rider is attached, here we go. What happens when you add PUAs? Yes, they go into cash value, but what else happens? Your whole life death benefit goes up. However, if you have that 1-year term rider attached, The term decreases by the amount the whole life increases, keeping you level at the same death benefit, which is a big reason why companies will allow large PUA payments, 10x the base premium, to be dumped into the policy without any underwriting. So this is a very technical video here. I know it was about dividends. I do hope that it was helpful. But if you enjoyed it, please let us know. Hit the like button, subscribe for more. If you have any questions, please leave them in the comments below. Particularly if you have follow-up questions, would like to see additional videos where we dig into more detail on this or simplify it. But in any event, I hope this helps. We'll talk to you soon. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.